The origin of the Wyckoff method. Richard Wyckoff developed a trading methodology after his experience as a broker. He was able to analyze how large traders behaved by observing their footprints in the chart and tape. His personal success with the method transformed him into a Wall Street superstar at the time. Wyckoff's 3 fundamental laws. Law of supply and demand in the financial markets. Supply and demand is a concept from economic trade but exists in any financial market. An asset's price goes up because the buyers are more aggressive than sellers or demand exceeds supply. On the flip side, the price of an asset goes down with selling pressure, supply overpowers demand, and prices fall. And then there's a third scenario. Supply and demand are more or less equal, resulting in a sideways market or horizontal trading range. The trading range represents almost a stalemate situation. To recap, prices rise when demand exceeds supply. Price drops when supply exceeds demand, and range is when supply and demand are equal. Traders and investors are non-committal. Of course, something has to drive these supply and demand dynamics. Enter Richard Wyckoff and his aptly named Wyckoff method. He believes price moves are never random, bringing us to his law of cause and effect. Law of cause and effect. Wyckoff theorized that every price change happens because of certain factors that prepare it. We know that markets don't move in a straight line but in steps. This is where the accumulation and distribution stages come into play. An uptrend, the effect, begins from an accumulation phase, the cause. On the other hand, a downward trend, the effect, happens after a distribution phase, the cause. Don't worry about the terminology too much, just keep those in mind for now. We'll go into these in more detail pretty soon. Law of effort and result. Richard Wyckoff reasserted that any market's price changes come from an effort represented in the trading volume. This leads to that asset moving in a certain direction, which is the result. Volume will be stronger on one side than another, whether uptrend or downtrend. Sometimes the volume is high but almost equal on either side, producing sideways movement or a small result in price movements. Hence the law of effort. The composite man. The composite man or composite operator isn't a law but an abstract concept. I liken it to the modern label of smart money. Richard Wyckoff states that any market is controlled by a large imaginary entity whose behavior contradicts what your average retail trader does. But at times, Wyckoff asserts that the smart money moves are somewhat predictable. In less figurative terms, he simply meant the biggest players, like institutional investors and so-called market makers. These entities exist whether the financial asset is Forex, crypto, stocks, or commodities. In the words of the man himself, all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operations. Let us call him the composite man, who, in theory, sits behind the scenes and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand it. Knowing the 3 fundamental laws and about the composite man, or in more modern terms, smart money, helps when it comes to the price cycles. This is the most complex yet intriguing part of the Wyckoff method. Wyckoff market price cycles. Price cycles form the bulk of the Wyckoff method, describing Wyckoff's observations of supply and demand. The trader once worked as a broker, giving him a vantage point to observe how powerful entities traded using bar and figurative charts. His extensive research led to the conclusion that any market moves in 4 distinct stages. Let's go through each of them here. Wyckoff accumulation. This represents the first part of Wyckoff's market cycle. After a downtrend, the smart money accumulates or builds their buying positions. This phase is a broad trading range or sideways market, a common trait when the price has moved in one direction for an extended period. Wyckoff divided the accumulation stage into little sub-phases. The price movements are each telling a different story. The end of the downtrend. Phase A. Here, the selling pressure decreases, eventually forming the preliminary support, PS in the graph, the second to last low before the range that persists in phases B and C. The selling climax, SC in the graph, is that final low, which forms after panic selling. Then the price retracts to create the automatic rally, AR in the graph. Notably, this push is a bit longer than the previous retracement legs. This suggests both the closing of short positions and early signs of institutional buying demand, which led to the secondary test, ST in the graph. ST doesn't exceed SC and eclipses AR slightly, indicating that more bulls are coming in. The labels Richard Wyckoff used are not so important, but his technical analysis approach is. How he saw trapped retail traders, the meaning behind the price cycles, market trends, and his prediction of subsequent price movement helped him ask the question why. Why should price move this way? Who is trapped and who is in control? He treated his Wyckoff analysis almost like a stock market science. Building the cause, Phase B. This phase is where the cause and effect law begins. Here, the price is in consolidation, where Wyckoff says that the larger player build most of their positions. Traders should expect traps or fake breakouts between the SC, ST, and AR points before the market moves into Phase C. The spring, Phase C. The spring is the last bear trap before the market starts to trend higher. Wyckoff affirms that the composite man ensures little supply or sellers remain. It offers the perfect opportunity for anyone to buy at lower prices. In rare cases, the spring does get broken, but this doesn't invalidate the cycle. This is often where you might see the low break fake trade setting up too. In the next video, we'll discuss the Wyckoff spring setup and low break fake trade. The effect, Phase D. This is where we see the transition from cause to effect. There is a notable increase in volume and volatility, consisting of one or many last point of support, LPS points. Here the price simply has one or more higher lows. Phase D comes with a break of the range from Phase B until the price SOS, signs of strength, meaning prior resistance, becomes support. Bulls take over, Phase E. This is what any Wyckofian analyst rejoices for, the last accumulation stage. It's clear as day that we are now in an uptrend. In reference to the earlier law, supply has exceeded demand. Higher highs, solid buying. You'll still get small pullbacks and flags, but ignition bars are commonplace and shorts are scrambling for cover. Markup. The markup is the next phase in the Wyckoff trading cycle after accumulation. As expected, the price action at this point is bullish. Wyckoff noted three patterns here: the upside breakout, jump the creek, and reaccumulation. Distribution, trading range. Needless to say, the distribution portion of Wyckoff's trading cycle is the opposite of the accumulation portion. The big players distribute or build their short positions after the uptrend. As with the accumulation phase, we expect sideways movement. Again, Mr. Wyckoff created little segments for distribution, except that the wording for a few terms differ. The end of the uptrend, Phase A. The buying pressure starts to fade to form the preliminary support, PSY on the graph. This is one of the last highs that shows some life of bulls who suddenly bring the price up, reaching the buying climax, BC on the graph. The market falls to form the automatic reaction, AR on the graph, where the big players distribute their holdings to late buyers. A secondary test, ST on the graph, happens a lower high next to the BC. Building the cause, Phase B. As with accumulation, the cause and effect law comes into play here. The market will trade sideways, making it the best time for the big boys to increase their selling power. A secondary test, ST on the graph, happens, a lower high next to the BC. We should anticipate several fakeouts at the SOW, or signs of weakness, and UT, upthrust points. The test, Phase C. The test serves the same but opposite function as the spring in the accumulation phase, the bull trap before the downtrend. While this level does get broken, it doesn't change the picture of the cycle. The effect. Phase D. Phase D in this distribution phase is a mirror image of the phase D in the accumulation cycle. There is a considerable surge in volume and volatility, compromising one or more last point of supply points, LPSY on the graph. A sign of weakness, SOW level happens, the final indication that the bears will soon take center stage. Bears take over, phase E. This stage is when the sellers are in full force, meaning the demand has surpassed the supply, and down we go. Markdown. The markdown marks the final part of Wyckoff's entire trading cycle. It represents the strongest leg of the downtrend formed from the distribution stage. As with the markup, Wyckoff created three patterns that can happen here: the downside breakout, break the ice, and redistribution. The Wyckoff trading method in action. The final piece of the puzzle is the 5-step approach that Wyckoff created for traders to use with his method. 1. What is the trend? 2. Determining the asset's strength. 3. Looking for an asset with sufficient cause. 4. Determining an asset's readiness to move. 5. Timing your entry. Some traders can get bogged down with the terminology in the different cycles. Yet, it's more important to know the overall stage instead of nitpicking each subphase. Markets don't always move exactly according to the theory, so it should serve as a guide, not the be-all and end-all. The key thing is to know which cycle the market is likely in. Recognizing range-bound activity is always the first point of reference. During these formations, the fakeouts, the test or spring, are significant in Wyckoff's cycles. Some traders may decide to enter the market using classic price action patterns that complement them. But some consider it risky as the market could break the range. An alternative is to enter once the accumulation or distribution stage is in phase E. Some traders may enter during the markup or markdown periods once the trend is in full force. Here they would use mean reverting strategies to take advantage of the pullbacks. So there are many parts to explore in Wyckoff once you understand where you are in overall market conditions. Let us look at the complete Wyckoff market cycle with real chart examples across 3 different financial markets, starting with Bitcoin. You can see the daily chart for Bitcoin showing the complete Wyckoff market cycle phases. Notice all the familiar elements, like the typical consolidation in the Wyckoff accumulation/distribution periods and the fakeouts before the price trended. The next example is the 4-hour chart of Euro to USD. Regardless of the time frame, Wyckoff reigns supreme with the classic elements of accumulation/distribution, ranges, and the test/spring points. Finally, for you swing traders, good old gold on the weekly chart. You'll notice that the distribution range has 2 test points. As Wyckoff stated, the first of these can get broken, but this wouldn't make the cycle invalid. It's also possible to have several attempts of a fakeout, as in the chart below. Mix Wyckoff's analysis with the price action, the time frame, and other market dynamics to get a good feel. Final word. One mistake some traders commit is regarding Wyckoff as a strategy. It's a skeleton, a technical analysis theory like Doe, Gunn, or Elliott. The key is to build a strategy around it, not that it's a strategy itself. Regardless, Wyckoff as a concept has stood the test of time. Markets do not move based on the Wyckoff method in many cases, but as with any market theory, it should only be one element among many others used when traders create trading ideas. I'd love to hear your thoughts, so feel free to leave a comment below. Please like and subscribe, it really helps support the channel. Thank you for being part of this journey.